Welcome back, everyone. I hope you all had a nice cup of tea and coffee to gear up for our next session. Now, the next session is one of the most dynamic pillars of India's low carbon transition, energy and feedstock transformation. The question today isn't just about scaling renewables, but it's also about transforming industrial feedstocks, fuels, and systems to align with our decarbonization goals. To take us through this thematic deep dive, I would now like to call upon Jaspreet Kaur from CPI to take us through this session.
Thank you so much, Divya. Very good evening, everyone. I will provide a brief overview of our analysis on energy transformation. So, India's energy transition is now entering a new phase, moving from renewable energy deployment to deep tech, energy flexibility, and decarbonization. The IIC CPI Green Investment Opportunities to 2025 report identifies energy storage and green hydrogen as the two most investable and transformative subsectors. So let me begin with battery energy storage systems. The case for battery storage in India is evolving rapidly. While lithium-ion batteries continue to be the backbone of the energy storage, momentum across the value chain is building toward alternative chemistries, along with innovation in battery management systems. On the demand side, the use cases of battery storage are also evolving both in terms of scale and application. There has been increased demand for utility scale renewable integration, grid stability and flexibility, battery storage for EVs and charging infrastructure. Now, if we look at the key trends, the installed BESS capacity has increased almost sixfold, rising from 51 megawatt hours in 2023 to 341 megawatt hours in 2024, and is expected to reach over 200 gigawatts by 2030. Globally, battery prices have fallen sharply from USD 115 per kilowatt hour in 2024 to around USD 55 kilowatt hour in mid 2025. This marks a 15% decline in just 5 months. On the policy front, there has been a push for storage growth. The viability gap funding has been scaled up. The PLI scheme is also there for advanced chemistry cells. And also, in February 2025, government issued an advisory on mandating energy storage integration in all future solar tenders. These policy efforts are playing a role in boosting storage capacity. From an investment standpoint, our analysis based on ISC data indicates that USD 274 million was raised in 2023 and 2024. The earlier years were driven by a few large players such as Exponent Energy, Battery Smart, raising high ticket size Series B funding, whereas 2024 saw a shift towards smaller ticket sizes, largely channeled into early stage deep tech, battery management systems, battery component and pack manufacturing. Despite strong investor interest, challenges such as dependence on import, high upfront cost, and supply chain and technology risk continue to exist. As the sector evolves, there are certain opportunity areas that have been identified. They are developing efficient and cost-effective battery management system, expanding battery pack manufacturing, and offering end-to-end bundle solutions, exploring non-lithium chemistries such as sodium-ion and solid-state batteries, deploying standalone or hybrid storage projects. There is also growing potential in EV battery charging and swapping, and also battery as a service model. Battery models in this space must also evaluate competitiveness of new chemistries and their adaptability in the Indian scenario. Also, investors need to be prepared for a longer payback horizon requiring patient and strategic capital. So on the whole, battery storage is now firmly positioned as a critical enabler of India's clean energy transition, supporting renewable integration, grid stability, and e-mobility growth. Now let's turn to green hydrogen. The domestic market for green hydrogen is gradually shifting from ambition to implementation. Green hydrogen is expected to meet nearly 15% of total hydrogen demand by 2030, and there is also significant export potential, particularly in green ammonia. The policy environment for green hydrogen is also strengthening, with National Green Hydrogen Mission laying the foundation. The government has introduced a series of incentives, tax cuts, and standardized decarbonization measures such as green hydrogen purchase obligations and reduction of GST on electrolyzers. Even as the policy momentum continues, the sector faces several challenges. Green hydrogen is still twice as expensive as grey hydrogen, and this is largely due to electrolyzer cost. There is also reliance on imports for electrolyzers, and there has been a demand creation gap as adoption in hard to abate sectors like steel, heavy transport and shipping remain still economically unviable. To bring down costs, electrolyzer innovation and localization will be the key. With an announced pipeline of nearly 34 gigawatts of electrolyzer capacity, there is strong momentum and demand signal for cost competitive domestic solutions. Now let's talk about the investment landscape. Though early stage, it is encouraging. As per our analysis, between 2022 to 2025, roughly USD 37 million in equity investments have been directed toward India's green hydrogen ecosystem, majorly focusing on electrolyzer technology, components, and deep tech innovation. Now talking about the opportunity areas. So we identified electrolyzer manufacturing as an opportunity area to localize production and drive cost reduction, component level innovation including membrane, catalyst, etc., large scale green hydrogen production projects which will anchor demand and attract long-term finance. From a business standpoint, manufacturers that build IP-backed technology, localize value chain, and meet international quality and safety standards will remain competitive. On the policy side, initiatives that reduce dependence on critical raw material and promote Make in India across the value chain will be essential to sustain the momentum. So to conclude, both battery energy storage systems and green hydrogen stand at a forefront of India's next phase. While storage is unlocking flexibility and stability for renewable integration, green hydrogen is opening pathways for deep decarbonization and industrial competitiveness. Thank you.
Thank you, Jaspreet. Now, to cover this topic, we have an interesting lineup of speakers who represent a vital part of this evolving ecosystem. Their insights will help us understand what it takes to move from pilot projects to mainstream adoption across India's energy and industrial landscape. We are pleased to have with us Mr. Akash from Peak Ventures, Stalin Sharma from Green Artha, Krishna Chaitanya from TNIFC, and Suman Jagdev from Zyto. And moderating this session is Sarthak Khurana from CPI. Over to you, Sarthak.
Yeah, thank you. Thank you so much for the insightful presentation. We'll quickly dive into the discussions because we're mindful of the fact that we're standing between this and drinks. So firstly, let's talk about mobilizing capital for energy transformation. I'll start off with you, Krishna. So how are investors approaching energy transformation? And in your view, is energy transformation coming up as a consideration for specialized funds? And are you seeing this in the integrated transition strategies that these funds are holding?
Thank you. Thank you, and good evening, everybody. Yeah, thank you, and good evening, everybody. That's an excellent question. In fact, what I wanted to start with is how has energy been integrated with mankind and the civilization? If you really look at it, people have used energy In some sense, it was food energy first, then it was energy which helped them for transportation, then it was energy which helped them with their basic work. And if you really look at it, the whole transformation has been from food energy to your fossil fuels to probably the decarbonized fuels and the new forms of energy to what we have just heard about how it is being used in the whole big data and all the computing and everything else that is required for us. Today we measure data centers in terms of megawatts and gigawatts instead of the kilobytes and megabytes. So that is how important energy is. Coming back to your next question as to how this whole energy transformation is taking place and how it plays an important role, we as funds or mobilizers or dispensers of capital, we also follow the trend and want the entire transformation to be in line with how the civilization is taking place. There are specialized funds. In fact, we now have a special emphasis on how this decarbonization or the transformation of energy is happening and how we want to look at this energy transition. Our own fund, we have a climate fund where we talk about the targets in terms of the 25 million metric tons of CO2 that we want to abate over the life cycle of our fund. And also we want to do the recycling because recycling also abates CO2. And is also energy efficient. So we have a 2.5 million metric tons of abatement in terms of recycling over the life cycle of our fund. So with all this being in place, we also look at how do we achieve this. We achieve this by looking at the whole energy transition or transformation as one single block or holistically, and which is the reason why, rather than telling that these are the areas, we do have sectors of our own specialization which are in line with what we have been discussing over the last few hours or before this. But by putting a number to it, the 25 million metric tons of CO2 and 2.5 million metric tons of recycling, we are looking at it in an integrated manner and we are looking at it holistically. So there are, along with us, there are other specialized funds which are looking at it. They are, of course, looking at it in terms of a sector. But the importance of this can be emphasized by the fact that more money has been mobilized for energy transition and climate in the recent few years than any other thematic fund. Thank you. I hope this answers.
Yeah, that's quite an interesting perspective. And I'll come to Soman and looking at the technology part of it. So which technologies or subsectors such as batteries, green hydrogen that we just saw, do you think are the most investment ready right now? And how is private capital placed to develop a focused investment thesis around these emerging themes?
Thank you, Sarthak. It's a bit of a tough choice, but I'll go with storage, and I'll tell you the reasons for that. So if I just look at storage, and if you just look at from a demand and a policy perspective separately, now if I look at demand, the demand for firm and dispatchable renewable power has been expanding the last few years, as we all know. And newer applications, for example, behind the meter applications are also emerging. There are newer spaces, and that is being led by ease of deployment and cost reductions. Now, storage is also becoming a core part of the grid infrastructure. Now, that is evident from the fact that about 170 gigawatt hour has been tendered since 2018 and 55 gigawatt hour in the first half of 25, which means there is traction in terms of policy as well as scale. Now, the capacity-based models for storage also make the storage infrastructure bankable, which means that multilateral funds, sovereign funds, and infrastructure funds find it attractive. And institutions like REC and IRADA come in with the long tenor debt. And we've also seen from the policy standpoint, policy also is trying to make the sector or the space a lot more bankable by providing clarity on price, demand, and clarifying rules of the game, which is extremely important. For example, we have the energy storage mandates and obligations, which are making sure that there is demand for flexibility being created, and flexibility is also being seen as investable. The policy-backed demand is making sure that developers are hedged for commercial risk. So policy in a way is actually enabling the play for different types of capital. And when it comes to private capital specifically, I think the space is conducive because there is alignment between the risk return symmetry and policy visibility, which is extremely important, and any investor would look at that. And it creates opportunities for private capital play either standalone or through blended finance structures. So that in a nutshell is in my view in terms of which technology has potential in the mid to long term. Yeah.
Okay, thanks. And on the point of flexibility, I personally and my organization has been working in understanding what is going to be the need of flexibility and what is going to be the financing requirement and where does the finance come from. And with that thought, I'll actually go to Starleen. So is financial innovation needed in this sector right now? And what kind of financial instruments do you think will be able to move the needle in building a marketplace and aid development of the sector?
So when we think about climate overall and climate finance, the problem is huge. The amount of capital that we see that is needed for it far exceeds the capital that's available. So there absolutely is a need for financial innovation. And when we think about some of the blended capital instruments that have been discussed throughout the day, there's really, the purpose of those is to do one of two things. One, get rid of actual real risk or de-risk instruments. And then the second is to alleviate perceived risk. And as an example, or specifically what I mean with that is, for a long time here in India, solar panels were not considered very bankable. And we saw a number of instruments that came in, innovations around business model, innovations around financing, that now made it so that more than 52% of the grid is renewables, and quite a considerable amount of that is solar, right? So financial innovation and business model innovation is absolutely necessary to bring technologies into the market and make finance comfortable coming in sectors where they're not. Where we see that there's a lot of need for financial innovation is not necessarily on areas where you have policy support coming in, because that's already making it so there is a market or a demand, but areas that are coming up and newer. So a lot of the areas around industrial technology, industrial decarbonization, we see a lot. Some of the areas that are coming up in terms of newer forms of industry generation or grid stability, where there's actual innovation happening, are the areas that we see there's a need. Very fundamentally, as we're looking at technologies moving into commercialization, there's a very significant need around business model innovation. And then across the capital structure, there's different times and places where different types of innovations needed. So when we look at companies that are more at the R&D or innovation stage, sometimes you're needing pieces of grant capital, which we see coming very often from the innovation and incubation spaces. As they start moving into early commercialization, that is not a place where debt is ready to come. So there's a very significant need to look at how can we make equity available, particularly when we're looking at first-of-a-kind factories, first-of-a-kind business models, and blending capital to make that viable. And then as the companies reach, or the technologies reach levels of maturity, or the business models reach levels of maturity, there's a need to then look at what we can do on the debt side, whether that be with guarantees or looking at new risk models for underwriting so that credit is more widely available.
Great, thanks. Yeah, quite an interesting point. And actually, just going slightly to the next level on that, and going to Akash for this question. So we are seeing deep tech getting more and more prevalent. We are seeing a wave of deep tech that is emerging. And how do we see the investment pipeline in this space come up? And what are the things that potential investors need to bear in mind to build deep tech expertise, especially because this is slightly different than a lot of other tech innovations that we see. Energy sector is very asset heavy. So how do financiers look at this part, and how do they build expertise in deep tech?
Yeah, for sure. Thanks. It's a great point, and I think the first thing one needs to do is you need to build that sector expertise, which takes time. We're a thesis-driven fund. We've produced around 28 internal subsector theses on things like methane, CCUS, wind, solar, biodiversity, and these each take like a month, month and a half to do minimum, and they are evolving over time. So honestly, the only way to understand these areas and then invest after understanding them is by doing the work. For hydrogen, we had looked at 85 companies globally before doing our investment in hydrogen. We did it in a Norway-based company that is doing waste to hydrogen. It's the lowest cost form of hydrogen that we have seen. We led that deal with a London-based fund called AP Ventures, and we co-invested with Aramco Ventures, Shell, Yara, and Sintef. And we are bringing that technology and scaling it in India. I think the thing with deep tech is it's very tough to say, okay, I want to do a macro theme like green hydrogen and then invest. You really need to look at the nuances as it pertains to not just the technology, but the geography, because many things that will scale in Europe and the US may not scale in India. And so I think our view is some of these spaces are very complex, especially when it comes to energy, waste to energy, sort of green buildings, things like that. And you have to take sort of a deep dive approach. Many of these, it's not necessary that deep tech means high capex. For the waste to hydrogen technology, actually, it's much, much lower capex than green hydrogen, which requires investment in infrastructure, electrolyzers, things like that. Here, it's a palladium membrane that you can set up, and you're using waste energy or waste gas streams that are produced on site. And so I would definitely distinguish between just deep tech and then high capex. So we come into the picture when we see sort of asset backability through venture rather than private equity and growth. And we do this for deep tech solutions. So that's kind of how we think about it. But I think one definitely shouldn't shy away from deep tech or even capex solutions in a space like climate. It's part of investing in this space.
I'll stay with you on that point, actually. So two things that you mentioned. One, that our understanding will have to be nuanced based on the geographies that we're looking at. And also, not all solutions need to be higher capex than the traditional solutions that we're looking at. However, our understanding in the sector and our analysis has shown that despite these obvious gains that are possible, there is some kind of inhibition that a lot of investors feel. And part of it is because of the risk that they're looking at, because technology risk is something that they're looking at from a geopolitical point of view. What is the geopolitical risk that they're looking at? So what are the financing structures that you see can help de-risk the early stage or deep tech startups in the energy space? And how can this be leveraged, especially for a country like India?
Yeah, it's a great question, and part of what was alluded to earlier. I think in India, one requires more than just equity financing. You can have mezz debt. You can have certain parts of the capital spectrum. The two GPs at the fund, Sabir has used to run a hedge fund and was previously at Goldman Sachs. Our other GP, Sanjay Nair, used to run KKR India. And so that financial expertise has to be in play when you are investing in this space, because it is not just, okay, we know the science and we can invest successfully. You have to marry both, because at the end of the day, we're a financial vehicle deploying capital into companies in the space of climate. And so financial structures are hugely important, and it depends on the type of thing being financed. We have an early stage fund, which is the core of what we do, which is Series A post R&D. We don't fund R&D, but we invest in scaling up, and we bring corporates to the table, both of whom are investors in the fund, but also who we work with closely to help commercialize these companies. But outside of that, we have also launched 3 joint ventures with publicly listed corporates who who are looking to do larger plays in India. So one is a $200 million waste to energy project with a publicly listed water company called VA Tech Wabag, where we are converting biogas to bio-CNG to sort of help catalyze India's shift from coal to renewable resources. The second one is in agri-waste to energy, where the corporate is replacing their coal with bio-coal from their own agri-waste. And those projects are not sort of equity, they are infra, and we have sort of growth investors coming on board along with DFIs. So I would say the question really depends on what you're financing and then who the right financiers could be. It could be early stage or it could be growth. It really depends, but one has to be open to defining the structure based on the investment.
Thanks. I'll pick on one thing that Akash mentioned, and I'll probably go to Suman. He mentioned that we need to look at technologies such as CCUS, and we've been working on CCUS for iron and steel sector. And one of the things we realize is that green finance essentially cannot work in that space. So we were looking at what is the other thing that can come in, and transition finance came out as one of the obvious solutions. So the question to you would be that how can transition finance be structured so that it helps traditional industries to adopt clean tech solutions without compromising on the cost competitiveness that they enjoy today?
Yeah, so through our experience of having worked with several organizations, especially in the hard-to-abate sectors, we have developed a certain approach which we believe is practical and pragmatic. So if I just take him through the steps, right? I think first is basically mapping out the entire transition portfolio. It's important to identify projects based on technology, maturity, which part of the value chain and assets they kind of connect with. The second would be assessing investability of the projects, looking at a payback period, looking at hurdle rates, looking at emission reduction potential. And then projects which seem viable, it's important to fast track them. And what that means is you fast track in the money projects, which also shows commitment towards transition, which is important for the corporates for various reasons, including investor and analyst responses as well. And for projects which are probably a low return or negative return, that's where structuring finance becomes important. And what we have seen is it's important to apply some kind of a sequential approach of matching capital with the project maturity. So if it's a project which is essentially more in the lab to pilot stage, that's where the catalytic capital becomes important. So philanthropic organizations and governments can play a role. When it's about scaling pilots or first of a kind projects, that's where concessional finance can be important, and which is backed by either say results driven grants which prove scalability of the project. And when it comes to industrial scale up, that's where blended finance structures would be important, which is basically combining commercial capital with factors such as first loss tranches. We've seen insurance companies play a role, or we say how do different factors come into play there. And that's essentially where a set of entities such as the government, DFIs, and the private sector can come together and solve for it. On top of it, what we have also seen is, we believe, so that there is need for a specialized institution which essentially plays a role in pooling grants, pooling funds, actually undertaking technical assessment, providing technical expertise and advice as well, to essentially make the transition projects scalable and deployable over a longer period of time.
Interesting. So, may I say a project preparatory facility for large projects? We have some experience running for smaller startups, but interesting concept. I'll come to Starlene, and this is something that we were just discussing outside before this panel started. So we have seen a lot of these things happen in the industrial sector, but we need to understand that there is a distinction between the industrial energy use and what is overall on the grid. And so how does energy transition differ across the grid innovation, grid scale solutions versus on the industrial energy side? And what implications does it have on investments in innovation?
So one of the things we've seen when we look at what is happening in India is a lot of the energy transition themes have really been driven by what's happening in developed economies, where there's really been a reduction in what is industrialization. Whereas here in India, we see very much that we're expecting a 16x increase in industrialization over the next 20 years. When you add on top of that, that right now only 20% of industrial energy is coming from electricity or grid, and that's when you're including service industries and textile industries and some of the industries that really have the ability to adopt grid energy. We see that there's really fundamental differences in what our energy mix is and how that functions. When you step back from that, there's also really significant differentials then in how the decisions are made. When we look at grid energy, it's much easier for the government at a centralized or state level to say, we want to support this and do things like the reverse tendering process to make energy viable and then to be able to build business models or financing models that fit. When we move over to industry, there are different drivers that drive both the type of energy that's needed as well as the decisioning factors that businesses have. So when we think of things like green hydrogen, it's great that there's now policy coming in to support that, because there is not a business in the world that's otherwise going to say, I want to pay 2x for my energy costs so that I can be green. They'll find other ways to green their supply chain. And so we need to be able to look at what are the right mechanisms and the right energy types for industries, taking into account that there's times where they need really high voltage, where there's a need for heat, where there's a need for a number of different factors that are not going to be supported by grid energy. And then we also need to look at, as we're thinking about what that means, how do we transition that and build for the future? Because when we think about what is happening in terms of this rapid industrial growth, if we grow with legacy or existing technologies that are standardized today, we're going to be locking in high emissions for the next 10, 20, 50, or 70 years. So there's really an imperative, particularly on the innovation side, the funding side, to start looking at what are the innovations that can first and foremost increase energy efficiency in industry. There's some statistics that say, like, for every kilowatt hour of energy you reduce, you're in terms of usage, you're actually reducing 2.3 kilowatt hours of production because of the losses in the systems. So that would be an area that we would see as being paramount to any of the other solutions that we might look at. And then from there, how do we start looking at things like what Akash was saying, making green coal or decarbonizing coal, because right now that is the cheaper solution, and we do see that industry will start shifting there. When we start looking at new fuel sources like hydrogen, you really have to be looking at new build, because companies that already have a boiler are not going to go change their equipment if there's still useful life unless there's a financial incentive.
Yep. Okay. Thank you for that perspective. And I'll shift gears a little here, and I'll come to Krishna on this. So we talked about startups, we talked about the private sector, large industries as well, we talked about the financiers. Let us talk about the public sector. Public sector plays a huge role in our energy ecosystem. And public sector themselves and public-private partnerships, they have a huge role to play. But over the years, we have seen that they have been a lead adopter of technology. There is some bit of cautiousness with which they tread, which is understandable. But what is it that they can do to actually become the lead innovators from the lead adopters right now?
Thanks, Sarthak. Thanks for this question. And if I have to just give a bit of a context, the public sector is usually the initiator as well as the accelerant. And then you have the public-private partnerships, which are some sort of a catalyst. And then we let the market forces, which is possibly the private sector, as we call it. And this private sector could be either a true private sector company or a public sector undertaking, which is also listed and which can be counted as private. So there are a couple of examples in this case. Let's take two examples in this energy transition or transformation space. One is in terms of stabilizing the grid by means of a storage solution. And while people talk about batteries, there is also the pumped storage system, hydro system. And this, because most of the riverine systems and the water bodies are controlled by the government, the impetus has to naturally be on public-private partnerships. And if you really look at it, the innovation that is being done, and as we speak, there are many of these tenders that are being either planned or which will come into the fore, wherein pumped storage systems will be built through a public-private partnership, where we look to stabilize the duck curve, as we call for the energy curve, or to manage the imbalances with more renewable energy systems coming into the grid. The innovations are numerous, and we will only see in the times to come how it will be transforming the entire energy landscape at the generation end. And public-private partnerships are playing a role there. I mean, there is no completely private project that can come in this sector. And that is where I believe that the public-private partnerships are playing the role of an innovator, as you have mentioned, and probably they will also lead in terms of many more to come in the coming years. The other example that I would want to look at is down the energy value chain or the electricity value chain, which is in the smart metering systems. The initial projects were done by the public sector. We had so much of that, and today the public-private partnership mode in which they are executed, there are, as we speak, more than 10 crore meters which have already been tendered, out of the 25 crore which is there in the country. And how does smart meters, it might look very innocuous, but if you really look at how it will transform the entire energy distribution, the amount of data that they can collect, the time of the day metering that can be done by means of the smart metering efficiently, and the way in which it can solve, or largely or partly, the fiscal problems of most of the distribution franchisees or the state distribution utilities, I think it's enormous. And beyond that, if you really look at what is being generated out of it, is that there's a parallel communication system which is being built by way of these smart meters, which can help in implementing the distribution franchisee systems, where even the last mile connectivity, you can have the option of choosing your distribution provider, rather than being the monopolistic way in which it is currently done. So these are the innovations that a public-private partnership, which today is looking as a smart meter project or a smart meter tender or a bid, it can do. And I think that is where I believe that the public-private partnerships are important in this entire energy transition, the entire energy transition that we are intending to do, and it will make things better for us. Thank you.
Thanks, Krishna. And so we have discussed on technology, on industries, financing. I'll zoom out a little and I'll pose a question to the entire panel. We have seen a neighboring country of ours take a lead in most value chains in this world. And energy value chains is something that is gaining momentum increasingly all over the world, increasing with AI, as you said, that we measure in gigawatts now. So it will gain more momentum. And this is a place that is opening up for newer innovation. So where can India place its foot to become the leader in global energy value chains? So if you had to give 2 recommendations to the country, what would it be? I'll start with you, Suman.
So I would say the 2 spaces would be probably solar PV module manufacturing and smart energy metering. And the reasons would be, first of all, there's a significant push from a policy standpoint. We have the PLI policies in place, and even otherwise, making them enabling spaces to push demand. And investors increasingly are also willing to underwrite policy-backed demand creation, which is basically where market creation becomes extremely important. And the value chains here in these two spaces are relatively streamlined. The ecosystem is maturing and maturing quite fast. And there are powerful scale effects. So they are relatively simpler to execute, fast to replicate, and can also create a basis for India to develop global competitiveness.
I would say the two areas where I think India will definitively lead in the energy transition will be around energy efficiency, where we already have proven efficacy, whether that be through the Ujala programs or whatnot. And the second would really be around the business model and financial innovation that is necessary for technologies to be adopted. And we see that at a national level with programs like the reverse tendering that was done to make solar viable and has been adopted in many other countries already. But I think that there's a lot of innovations that are happening at the business model level, which is an area we really like to invest, as well as at the fund level, where like we as a fund, for example, are looking at innovative models for enabling first-of-a-kind financing. So I think that India really, especially as one of the leading economic developing economies, really has an ability to create templates that are transferable to the rest of the world, or at least the rest of the global south, where we're going to see heavy industrialization and the ability to have energy efficiency within it, and then better financing mechanisms.
Great. Krishna, your views on this?
Thank you. India today has one of the most interconnected grid. I mean, technically and theoretically and even practically, we can transfer an electron all the way from Kashmir to Kanyakumari, which is something that no other country can boast of, a country as large as India. Even the European Union can't do that. Even the American grid system is not really integrated. All I would say is, let's keep the momentum going. Let's make it, we don't rest on our laurels and make it better. The other aspect that I would want to say is, talk about is about energy efficiency and smart energy metering at all levels. And what it would give is, it would give us the data, and it would, we have proven to the world about how well we can use data with our own Indian innovations, or our own way in which we do the innovations in terms of the UPI and everything else. So I think if we have the data, I think we have the knowledge base, and we have the capability as a country to take it further and possibly develop newer innovations and accelerate our own energy transition. Thank you.
Akash, your views?
Yeah, I would frame it slightly differently. Like, where can India be sort of that role model for the rest of the world? I think first one on like energy transition from the waste to energy perspective. Most of our grid is fueled by coal. I think we also produce a lot of waste that can be used. So agricultural waste as well as biogas, things like this. So we can build very, very large-scale models in an economically viable way that can change the perception of how one can use waste to fuel your economy. So it's more than just renewable or solar, and we've really taken sort of a huge leap as it comes to solar. But I think the next space will definitely be using our waste generation for energy, and we can really play the leading role there. The second one where honestly we should lead is in water. And water is an area where India suffers from a lack of availability and quality of water, and we will be one of the hardest hit. I think that is a space where we have the potential to lead, and this is a combination of wastewater treatment, desal, low-cost desal, and drinking water. And so this is where sort of we are placing some of our bets, and also where India should and can take a leading role on the global stage.
Great. So if I can summarize, so lead in solar, lead in energy efficiency, innovative financing structures, lead in data sciences as from energy efficient meters, from behind the meter innovations, from smart metering solutions, waste to energy solutions and water. And if I may add my own perspective, probably green hydrogen is a solution where the ship hasn't yet sailed. And right bets being placed on that might help create a solution where India becomes a net exporter of energy in the green hydrogen space. That's all that we have from the panel. We're happy to take questions if there are any. Yes, gentleman there. Would request you to please share your name and the person you would like to direct the question to.
Hi, again, myself Jai Shankar. I represent GT Bharat Financial System Consultancy, and my query is to Krishna Chaitanya. Of late, we have been creating some policy, lending policy for one of the reputed NBFC for financing BESS and PHS and AMISP. Now, one relevant portion came when we did for AMISP. It is something like this. So AMISP is not a typical project finance. It's more of like a bill discounting facility, right? Might be a 9-10 years kind of a facility. Biggest challenge which we faced while writing the policy was that, one, the initial milestone of say 5%, whatever is the deployment stage, pilot stage that we call. At that time, how the lender gets covered. As we understand today, there is no guarantee being provided by neither the state government nor the discoms for the lender for financing that 100 or 200 crore packet of finance for 10 years. So how to address it was a big challenge for the lenders, because provisioning side also it impacts. So at least till DCCO, do you have a facility wherein you guarantee the lender for giving a facility under AMISP? That's my first question. Second one, RDSS, whatever per meter, whatever allocation is being given to discom directly and not to the lender. Even though you have a DDF arrangement and all, is there a provision for creating a charge on whatever that VGF comes per meter, whether the lender will have a provision to create a charge on that money? Is a second issue that we faced. We tried to get an answer, but since it's a very evolving system, we were not able to get. So great we met today.
Okay, let me start with a disclaimer that smart energy metering is something of interest. I've been involved in that since 2017, 2018, so I'm just making these statements. And we are a category 1 fund. We have a climate fund, and I'm not, while government is our leading shareholder, I have nothing to do with the government. So I just wanted to make these things as a disclaimer before I can attempt to answer this. The queries that you have raised, or the concerns that you have raised, have been something that, to the best of my understanding, have been discussed, and every incremental bid that is coming up, the discom, the government, the ministry, everybody seems to be understanding this and iterating them. So this is a process like the NHI. I mean, I've been involved in infra financing since the early 2000s, if I have to put it that way. So it is something similar to your NHI master concession agreement, where at every iteration, some of these concerns have been taken up and they got resolved. Having said that, the concern that you have raised in terms of the pilot stage and the lender not getting covered, this is where what I'm given to understand, or what I understand, is that the concessionaire has to take that risk. This can't be a risk that is allocated to the lender. The lender's risk comes when the pilot is proven, and if the concessionaire is able to raise money from the lender, with the lender understanding the risk, then well and good. But otherwise, the main objective of that is that this is a concessionaire risk, is what I'm given to understand. I hope this answers your question. I'm sure it is not fully addressed, but I think it must be taken up with the relevant people or the decision makers, I should say. Thank you.
Great. Do we have any other questions? I don't see any, so happy to give back 6 minutes. Thank you. Thank you to the panel. Yeah.
Thank you, Sarthak, for moderating this wonderful session, and thank you to the speakers. This is the end of day one. It has been an amazing day with wonderful, insightful, and powerful discussions. We look forward to another great day for tomorrow.